$74 billion in shareholder value vanished in just 24 days. It was not a sudden market crash, nor an unpredictable natural disaster, but a meticulously engineered illusion that shattered the seventh largest corporation in the United States. Enron, a titan of the energy sector, did not merely fail in the marketplace. It was hollowed out from the inside by its own visionary architects, leaving 20,000 employees jobless and stripping them of over $2 billion in pension funds, all while executives quietly cashed out their own stock. This was a masterclass in corporate deception, a labyrinth of hidden debt that brought Wall Street to its knees and permanently altered the landscape of American business. The seeds of this colossal collapse were sown in the relentless pursuit of an innovative image. Founder Ken Lay envisioned a company that transcended traditional gas pipelines, seeking to transform the physical energy market into an abstract financial trading floor. To execute this grand vision, he brought in Jeff Skilling, a brilliant but ruthlessly pragmatic consultant who believed that sheer intelligence and aggressive trading could conquer any market reality. Their combined ambition birthed a corporate culture where booking immediate, headline-grabbing profits was the only metric of success, and failure to meet Wall Street expectations was considered a fatal weakness. To satisfy this insatiable demand for exponential growth, the company adopted a highly controversial financial practice known as mark-to-market accounting. Under traditional accounting standards, a company records revenue only when it actually receives the cash from a transaction. Mark-to-market, however, allowed executives to estimate the future profits of a long-term contract and book that entire projected amount on the very day the deal was signed. If a 20-year energy contract was projected to earn $50 million over its lifespan, that entire sum was recorded on the ledger immediately, creating a massive, instantaneous surge in paper revenue. The reality of these futuristic projections rarely matched the actual cash flowing into the corporate accounts. When deals inevitably underperformed or failed entirely before a single dollar was collected, the company could not simply erase the previously reported profits without triggering a panic among investors. This widening discrepancy birthed a toxic internal environment. Traders and executives were heavily compensated with massive bonuses for closing deals based on phantom numbers, entirely divorced from the actual execution or long-term viability of those contracts. To enforce this culture of relentless, aggressive growth, management instituted a brutal employee evaluation system known internally as rank and yank. Every year, the bottom 15% of the workforce was systematically fired, regardless of their absolute performance, creating a paranoid, hyper-competitive atmosphere. Employees quickly learned that raising concerns about questionable accounting or unviable projects was a guaranteed path to termination. Survival required absolute compliance with the illusion of profitability, effectively silencing any internal dissent or ethical hesitation. As the gap between reported revenue and actual cash widened into a catastrophic chasm, the corporation needed a mechanism to hide its mounting losses and highly toxic assets. The solution came in the form of special-purpose entities. These were intricate, off-the-books shell companies created specifically to conduct isolated financial transactions. While perfectly legal when used correctly to manage specific project risks, they were weaponized here to act as financial black holes. The energy giant transferred its failing assets and massive debts into these hidden structures, keeping the liabilities completely invisible to the public. Chief Financial Officer Andrew Fastow became the dark architect of this subterranean financial network. He orchestrated dozens of these complex partnerships with names like Chuco and LJM, structuring them just carefully enough to bypass technical ownership rules that would have required their consolidation into the main corporate financial reports. Fastow did not merely design these vehicles to protect the company. He actively managed them as a private citizen, collecting tens of millions of dollars in personal management fees while simultaneously representing the corporation in the very same deals. The entire facade relied heavily on the complicity of the gatekeepers who were supposed to protect the investing public. Arthur Andersen, one of the most respected accounting firms in the world, served as both the external auditor and a highly paid consultant for the energy titan. This dual role meant the firm was auditing the very financial structures it had helped design and implement. The lucrative consulting fees blinded the auditors to the glaring irregularities, transforming independent watchdogs into compliant enablers who signed off on increasingly desperate financial maneuvers. The internal architecture of the fraud grew increasingly precarious as the hidden debts multiplied. The special purpose entities were heavily capitalized with the corporation's own rapidly inflating stock. As long as the share price continued its meteoric rise, the shell companies remained technically solvent, and the hidden debts stayed buried beneath layers of complex financial engineering. The entire structure was a massive self-referential loop, entirely dependent on the market's unwavering belief in the company's projected brilliance. The impenetrable armor of this financial juggernaut finally cracked under the scrutiny of a single persistent question from a financial journalist. Bethany McLean published a searing article asking exactly how the celebrated company actually made its money, pointing out that its financial statements were entirely incomprehensible even to seasoned analysts. This public skepticism acted as a catalyst, prompting institutional investors to finally look past the soaring stock price and demand actual transparency regarding the labyrinthine off-balance sheet partnerships. Sensing the impending implosion of their carefully constructed empire, the architects of the illusion began to orchestrate their exits. Jeff Skilling abruptly resigned as chief executive officer, citing vague personal reasons just months after taking the position. Behind closed doors, top executives frantically sold off hundreds of millions of dollars of their own shares. Meanwhile, lower-level employees were locked out of their retirement accounts due to a conveniently timed administrative change, forcing them to watch helplessly as their life savings plummeted to zero. Internally, the panic reached a fever pitch as a brave executive attempted to sound the alarm. Sharon Watkins, a vice president of corporate development, sent an anonymous memo to Ken Lay, warning that the company was on the verge of imploding in a wave of accounting scandals. Instead of launching an independent investigation, Lay ordered the company's outside legal counsel to review the matter, a firm that had previously helped structure some of the very deals in question. Predictably, the lawyers concluded there was no reason for concern, burying the warning as the crisis accelerated. The sudden forced disclosure of billions in hidden debt triggered a frantic response from federal regulators. The Securities and Exchange Commission launched a formal inquiry, sending shockwaves through the financial sector. In a desperate attempt to contain the legal fallout, Arthur Andersen employees engaged in a massive coordinated effort to destroy evidence. They shredded thousands of documents and deleted highly sensitive emails related to their audits, transforming a complex accounting investigation into a massive criminal obstruction of justice case. The bankruptcy filing, when it finally arrived in December of 2001, was the largest in American history at the time. The sheer magnitude of the collapse sent a chilling tremor through global markets, erasing billions in institutional investments. It devastated the portfolios of countless retail investors who had trusted the relentless buy recommendations of Wall Street analysts who had continued to promote the stock even as the company bled to death. The illusion of the new economy was shattered, leaving a trail of financial devastation. The ashes of this unprecedented corporate disaster exposed fatal flaws in the very foundation of American financial regulation. The realization that a massive publicly traded entity could completely fabricate its profitability while passing every required audit demonstrated that the existing oversight mechanisms were entirely inadequate. The systemic failure demanded a profound legislative response to prevent the complete erosion of investor confidence in the integrity of the capital markets. Congress responded with the Sarbanes-Oxley Act, a sweeping piece of legislation designed to radically overhaul corporate governance. The law mandated strict new rules for financial disclosures, requiring chief executives and chief financial officers to personally certify the accuracy of their accounting statements under threat of severe criminal prosecution. It also forced the strict separation of auditing and consulting services, fundamentally altering the business model of the major accounting firms to ensure they could never again be compromised by conflicting financial interests. The pursuit of justice for the architects of the fraud culminated in a series of high-stakes criminal trials that captivated the nation. Ken Lay and Jeff Skilling faced juries of their peers, forced to defend a corporate culture built on arrogant deception. Prosecutors meticulously dismantled the defense that this was merely a complex business failure, proving instead that it was a deliberate systemic conspiracy to defraud the public. The convictions of the top executives served as a stark declaration that the era of absolute corporate impunity had ended. The collateral damage of the scandal extended far beyond the immediate executives, destroying the enablers as well. Arthur Andersen, a firm with a 90-year legacy of prestige, was convicted of obstruction of justice for its widespread document shredding campaign. Although the Supreme Court later overturned the conviction on a narrow legal technicality, the reputational damage was irreversible. The firm surrendered its licenses to practice as certified public accountants, effectively dissolving the company and putting 85,000 people out of work worldwide. The echoes of those early accounting tricks still resonate through modern financial markets. While the specific mechanisms of the off-balance sheet entities have been heavily regulated, the underlying human impulse to obscure risk and inflate value remains a constant threat to market stability. The collapse stands as a permanent monument to the dangers of unchecked corporate ambition, a stark reminder that when extreme intelligence is uncoupled from basic integrity, the resulting destruction can devastate the entire economic landscape. Ultimately, the true cost of the scandal was not merely measured in lost billions or shattered companies, but in the profound destruction of public trust. It revealed a terrifying reality where the smartest men in the room could build an empire of air, and the systems designed to protect society would actively help them hide the truth. The legacy of this giant's fall is a permanent vigilance, a lingering suspicion that behind the next soaring stock price or revolutionary financial innovation, another labyrinth of hidden debt might be waiting to consume it all.